Hello, and welcome to the August 2023 Real Estate Market Update brought to you by the Reedy Homes team. Kicking things off with what's happening nationally, as always, headlines are a great place to start. So let's take a look at some recurring headlines we saw last year surrounding predictions for home prices, foreclosures, and inventory in 2023, and then compare them to what's actually occurred. We saw an overwhelming amount of predictions that home prices would fall as much as 20% or more in 2023, among many other headlines that supported a similar notion. Well, now that we have 6 months of data to compare those headlines to, we can see just how far off they were. Here's a look at what has actually happened with prices so far this year. The black bars represent the 48-year average home appreciation rate each month, and the green bars represent where we are today. January of this year fell below the average, which was not surprising given the correction that happened in the second half of 2022. And then we see prices inch closer to normal appreciation in February and eventually passing normal appreciation in March, April, and May. For reference, here's a look at the major price indexes reporting the same story. Case-Shiller, FHFA, and CoreLogic all show below average appreciation from July 2022 to January 2023, and then the uptick in values from February on. Zillow, Black Knight, and Freddie Mac, same thing. Here's a look at price forecast adjustments from MBA, Fannie Mae, Morgan Stanley, AEI, Zillow, and CoreLogic. Majority started the year with negative forecasts, CoreLogic being the only optimist forecasting a positive 3% appreciation, and taking the award for biggest pessimist predicting as low as 15 to 20% in depreciation is AEI. However, all have since revised their forecasts due to the last 6 months of data reflecting a very different story. Moving on to inventory predictions, this graph shows inventory trends from 2017, 18, and 19 are, quote, more normal years that show a buildup in the spring, a drop-off in May as it starts getting hot, and then a steeper drop-off in the winter. This happens every year and is not a surprise. So in May of last year, when listings didn't immediately trend down, but up for another month, economists quickly jumped to the conclusion that listings would shoot up, demand would tighten as interest rates were high, and it would ultimately cause prices to come crashing down. That is what caused a flurry of news articles reporting that a crash is on the horizon. However, we now know that did not happen. Here's what inventory actually looked like from June to December. The drop-off they were expecting in May was just delayed until the end of June, and then continued with the expected seasonal trend down. And the last category that was heavily pushed yet also refuted is foreclosures. This from Bill McBride with Calculated Risk. In 2008, he stated foreclosure activity was at record levels, and as prices continued to fall, foreclosure activity would likely increase. This year, however, his story is a little different. He states that there will not be a foreclosure crisis this time around. And there's a reason for that. Here are the delinquency rates from January 2022 to June of this year. A steady decline likely due to the immense amount of equity homeowners were gifted over the last 3 years and the likelihood of majority having the interest rate in the 3% range, making their mortgage pretty affordable. Speaking of mortgage rates, the last national topic we'll touch on, Fannie Mae, MBA, and NAR are predicting rates to be in the low 6s by Q4 of this year and then into the high 5s by the first half of 2024. Of course, only time and the Fed can tell. But if their predictions are correct, strap in because it's going to be another crazy ride. And now a look at our local data here in the Phoenix metro area. Currently, we still have incredibly weak supply and demand, which is causing prices to remain fairly stagnant, and interest rates lingering in the 7% range is less than attractive. Historically, average list counts sit between 14,000 and 17,000 active listings. Today, we have 9,916, and it's now the third month in a row we've been under 11,000. Average price per square foot from June to July dipped about 2%. It went from $288 a square foot down to $282. However, that's consistent with seasonal trends going into the hottest months of the year, so not necessarily an indicator of declining prices. Another seasonal trend making its appearance is sales volume. There were 6,920 closed sales in June and only 5,538 in July, so no surprise there. So what does this mean for prices? Well, it's basic supply and demand. In order for prices to fall, supply would have to outpace demand significantly. Although our demand is weakening as weeks go by, our supply is deteriorating even quicker. Not to mention, the Arizona delinquency rate is minuscule when compared to the number of foreclosures we would need to see in order to combat the inventory crisis. So why is supply and demand so low, and what has to happen for that to change? 2 words, interest rates. Interest rate movement over the past few quarters has been boring. We're seeing a fun little sequence of them jumping up to a point that scares both buyers and sellers out of the market, and then quickly correcting them to the 6.8, 6.9% range we've all come to know so well. Until there's some more exciting movement in the interest rate department, expect a little change. Some good news, seller paid closing costs are hanging in there at 43% with an average amount of $8,100. Although that's down from 51% in January, it's still well above the 20 to 25% from this time last year. So buyers, don't step over that. $8,100 could do some generous adjusting to that interest rate for you. And at a time with little to no competition, your position to negotiate is strong. 22% of sales in July closed over list price by an average of $5,100. This is down from the peak of the market that saw almost 60% of sales close over list. However, it's been steadily increasing again since January, which was at 11%. Average days on market reached 81 at the start of the year following the adjustment in Q3 and 4 of last year, but is consistently trending down, landing at an average of 58 days in July. And last but not least, the rental market. Year over year, lease price per square foot is the same at $1.37 a square foot. September of last year through about March of this year saw a little bit of a dip, hovering around the $1.32 to $1.34 a square foot range, but has since recovered back to that $1.37 a square foot. Average lease price ending Q3 was $22.95, which is up from $21.95 in Q2 and $20.89 in Q1. Bottom line, it's not the most exciting time in the market, but as the great Winston Churchill once said, a pessimist sees the difficulty in every opportunity, an optimist sees the opportunity in every difficulty. Go find the opportunity. We're happy to help. Thanks so much for tuning in to this month's market update. As always, if you have any questions or want to see data in your specific area, please don't hesitate to reach out. We're here to help. Take care, and we'll see you next month.